Hey, everybody, welcome back. And it's another beautiful week out there. So here's the funny thing. Mortgage rates, as always, the key to a lot of the buyer activity that's going down right now. We're seeing some of the lowest rates in some scenarios from earlier this year. Some say, hey, these have been the lowest rates since 2022. How that is affecting the buyers in our market, what's going on, what to expect, let's get at it. Okay, so here's the funny thing. When we talk about mortgage rates and how they affect everything that's going on, there's a really crucial thing that's coming up this coming week, and that is the feds are actually meeting. And you might say, George, what the heck? Why is that important? Well, it's important because exactly 1 year ago, remember, we were at like 6.02 interest rate. We had come way down. We were looking really good. Feds dropped the rates a half a point. Everybody was like, yay. And of course, then we're like in the mortgage world, we're like, no, because rates went way up again. You're going to see that here on the Freddie chart in just a second. So, and in fact, the subsequent drops that the feds did, again, rates already went up. And then when the feds didn't drop rate, we also saw rates kind of go up. And people were like, what happened? Well, that's because a lot of times they actually start building in rate drops in anticipation of the feds doing their thing. And then the market tells the mortgage rates what they're going to be. Because remember, feds don't control mortgage rates. And a lot of people are like, I don't understand that. Feds control what your car loan is going to be, what your home equity line of credit or a HELOC is going to be, many times what's called a second mortgage, what your credit card interest rates are based on, and of course what banks lend to each other in commercial lending. The mortgages are traded out in the market as far as your bonds and your mortgage-backed securities, things like that. Those are the things you want to watch. Easiest number to watch is a 10-year treasury. They're not tied together, but they freakishly follow each other. So keep that in mind. So watch your 10-year treasury. If it goes down, mortgage rates go down most of the time. When they go up, mortgage rates go up most of the time. Okay. Now, here's the thing. When we talk about the signs of life, what the heck is going on? It says, look, the downward rate movement spurred the strongest week of borrower demand since 2022. Purchase applications increased to the highest level since July. And then, of course, the highlighted section below, the refinance index rose by 12% from the previous week. And that is not unexpected because as people are enjoying that, 6.25, 6 3/8 rate, since we've been closer to 6.5, between 6.5, 6 3/4, as high as 7 over the last 60, 90 days, we've benefited from that. But the question will be, next week, what's going to happen with the Fed market, right? Because as we take a look at some of our headlines here, it says, look, obvious signs of life, mortgage apps, applications are up. Home prices still growing, bottom left, but at a slowest pace since 2012. And you know what's super funny about that? We have seen an uptick in our activity. This is a normal slow time. People forget that. Post July 4th until really about the middle end of August, that's going to be our summer spurt. Okay. Then from, the end of August through about the end of September, we really slow down actually quite a bit. And the reason is you got kids getting back in school. You got college kids getting back in school. You have last minute vacations before snow flies. People are doing other things. Seasonally normal. In fact, some of the closings that you're seeing now, which most of them actually, those are from August. Okay. So remember that because solds lag 30 days. Average close is 30 days. So they lag. And so any closings, any solds that we see, especially on our running 7-day average, that is from August. Okay. So this is real-time information. That's the best part. We'll head into that a little bit more. Let's come back here. Look at that. We got the 30-year fixed is at 6.29. It went up just ever so slightly. And then, of course, mortgage rates back to long-term lows. And that is absolutely situation normal. We are hoping that, well, there's a high probability based on the jobs and not so much CPI, but the jobs report. Inflation is holding itself. It's maybe gone up a tiny little bit, not a whole lot. Feds may do a rate drop because of this. We will have to see, and then we'll see what happens if we have a repeat from last year where mortgage rates went way up when our activity right now is moving really, really well. So let's take a look at Freddie. So as you can see from our chart here on the left-hand side, that's where we were at last year. And when the Feds did their drop, you can see how they absolutely, just wanted a Mount Everest climb upward. And then it took almost this entire year to get down to back into the lower sixes. But as you can see, not nearly as low as where they were at last year. Not uncommon. Just understand that as we take a look at that, translates into time on market, what's going on with buyers and sellers. So if we take a look, we can see that we've got our list to sales price. We are actually hitting about 97%. In other words, when we take a look at this, if we sell for $100,000 or if we list for $100,000, we sell for $100,000, that's 100% list to sales price. Now, if we list at $100,000 and we sell at $97,000, okay, that's a 97% list to sales price. We're 3% under. A little bit less than where we were at last year. Last year at this point, again, we were down 6.02. We're bobbling around 6.3 right now. Tad bit higher, a little bit more inventory, few more options out there, but people are a little wary because we have our 3-year cycle of hire, fire, retain, hire, fire, retain. Anyway, there we go. All right, and that's in the tech world. Okay, so let's come back here again. Hang on. There we're at. So when we take a look at the running 7-day average, let's blow that up. Look, we had 1,177 homes that came on. We had 1,143 that went off. Now, what's super interesting about that is that midweek we were only at 750 homes that came on market, and we still had 1,100 homes that went off market. So this is telling us very clear, we have coming on, we have coming off, and they're basically equal, maybe going off just a teensy weensy bit higher, which is because of rates being down as low as they are. If we see rates bop back up to 6.75%, 7%, whoop, that's going to put the buyers back on the sideline because they're going to wait for Q4, fourth quarter, for those to come back down. So just keep that in mind. So as we take a look at what's going on, we are seeing the normal seasonal cycle. And for sellers, just understand, we're going to be seeing a lot of things that you're going to want to pay attention to. And that is any buyer that now starts coming through between now and really the middle of December, take them very seriously. Builders definitely are. We're seeing that steady movement going across. We're seeing some tightening on some of the products. We've seen some builders offering, well, just a few more things. So let's jump into the Northwest MLS. So what the heck is going on there? So when we take a look at our numbers actually are doing quite well. Let's blow this up a little bit for you. So upper chart, you can see that our pendids are up 1.9%, almost 2%. And then, of course, we're up 1% again on actual solds. That's not a monumental jump, but it just shows that we're continuing to move forward more in a flatter market, residential only. Okay. When we take a look at September year over year for the same month since, basically we're on the 13th, 12th, 13th here. Look, solds are up 4.6%, which was from August. And then, of course, our pended, the dynamic number, what's going on today, those are at 22.4%. And what we're seeing here, again, is that continued growth as rates start coming down. If we see rates go shooting up a half a point, 3/4 of a point, those buyers are going to go back to the sidelines. They're going to start waiting it out. And then that will affect our pricing and whatnot. All right. So if we head over and we take a look at our actual average sales price for the month of September year over year, we're up 4% and basically up 1% year to date. That is consistent with what we have seen year over year. We weren't expecting monumental numbers, but that is what it is. Now, part of that is competition coming from new construction. And when we take a look at these numbers, look at our September September numbers here. Let me blow this up for you. September numbers show us that, we're basically about 60 homes more that have gone pended, that's bottom chart, than where we were at last year. And that's fine. They needed a little recovery. They offered some pretty amazing incentives, all things considered. We're off on our actual solds. And remember, those solds that we're seeing, those are from August. In August, we saw a modest amount of activity. We did see some increase in some incentives and whatnot. And that is going to be starting to translate what we're seeing here in September. Because as we take a look at our pricing, pricing is up 21.2% where it was at last year. Year to date, they're still up 2.6%. That's pretty impressive still, all things considered. When you take a look at what people are doing, what is happening in the market, when we take a look at some of the builder incentives like this, where they say, hey, listen, we're going to give you 3.62% on your first year buy down, and then you're going to have a fixed rate of 5.68 at the end of the day. Actually, that's just the APR. The fixed rate will be a little bit less than that. That's a pretty good deal. When you take a look at interest rates, the trade-off is smaller lots. You get new construction, and you don't always get the area that you want to be in. Yeah, there you go. All right. So if we roll over and we start taking a look at bank-owned homes, here's the funny thing with bank-owned homes. So I heard a report, and of course, I asked them, I say, hey, how many homes is that? And they couldn't answer. They just gave me the number of, hey, we have a 20% increase. And I'm like, really? I said, that's super interesting. I said, I know that 20% increase. And as you can see here, this is a snapshot, except for the X'd out ones. Those are just mismarked listings. They are not REOs. And I said, that 20%, that's the sold. You said, hey, solds are up for the month of September over 20%. And this is starting to head towards a crisis. I said, did you know that that's only one home? Yeah. Here's the thing. Make sure that when you're taking a look at metrics, that you're looking at a real thing. Right there, 20% difference. Look, that's one home sale. 5 to 6, 20%. Right? Let's be real, people. Our foreclosures, our inventory of REOs is super low. We are still below 2% even on defaults. Well, at least some of the information, which is 6 months lagging on the Fed side for reporting. But we do not see a lot of notice of defaults. We'll see a modest amount, but our area is still one of the top 5 sweet spots across the United States, and keep that in mind. So as you're seeing some of these crazy numbers that some folks are using to justify additional taxes, don't fall for it. Make sure you get the real information. So leave your information below. Okay. Ask your questions. Let us know what you're thinking. In the meantime, have an absolutely fabulous weekend. Don't forget to subscribe. Smash the subscribe button for us. Let us know you like what you hear. There's no marketing. It's free, and it's every week. In the meantime, have a great weekend. I will see you on the next video. Take care.